Fusion Mobile, quality e-learning experience on the go.
Capital, definition, and types. Two schools of thought or views appear to hold motion in the definition of capital. These are the accountant's point of view and the economist's point of view. We also have the layman's understanding of capital. The accountant's point of view states that capital is the original fund or money with which a person uses to start a business, while the economist's point of view states that capital is the resource or wealth made by man that are used for producing further wealth. The layman's understanding of capital states that capital is the total money for running a business. We have different types of capital, which includes the authorized, registered, or nominal capital, the issued capital, the called up capital, the paid up capital, uncalled capital, capital employed, capital owned, fixed capital, loan capital, liquid capital, working or circulating capital. The authorized, registered, or nominal capital is the total amount stated in the memorandum of association and approved by the registrar of companies, which a company can issue out for subscription. Nominal capital is the total amount of capital which a company is authorized to issue out to the public. It limits the amount that can be issued out as shares. Take two. It limits the amount that can be issued out as shares. Take two. It limits the amount that can be issued out as shares. The issued capital is part of nominal capital that the company decides to issue out to the public for subscription. The called up capital is the part of the issued capital that has actually been called up and the shareholders have been asked to make payment. This kind of capital is the part of the issued capital which is expected of the shareholders to pay for. Take two. Which is expected of the shareholders to pay for. Paid up capital. This is part of the called This is part of the called up capital which the shareholders have actually paid for. It is the total amount paid up or credited as paid up on the issued share capital. The uncalled capital is the total amount that has not been called up on the issued share capital. It can be referred to as part of the issued capital that is yet to be called up for payment. The capital employed is the total assets, both fixed. The capital employed is the total assets, both fixed and current, less current. The capital employed includes the total assets, both fixed and current, and the less current liabilities. The capital employed is the actual amount of money and other assets used in the business. It can also be referred to as the total assets of a business and can be calculated as total assets minus current liabilities. Capital owned is the owner's financial interest in a business. It is the excess of total assets of a business over the value of its total short and long-term liabilities. In summary, the capital owned is the net worth of a business. The fixed capital. This is the durable capital of an enterprise which is used continuously for further production. Fixed capital are not intended for immediate consumption, but rather as a means of production. It comprises of assets Take 2. It comprises assets of a firm which are of durable character. For example, furniture, fittings, machineries, etc. Fixed capital do not change form in the process of production. The loan capital. The loan capital is the total amount of money a business borrowed from external sources. It is a term frequently applied to debentures and other fixed loans. The liquid capital is made up of assets. Take 2. The liquid capital is made up of assets that can be easily converted to money. That is, these assets that can be turned into cash at such a short notice. This consists of cash, near money, bank balance, and debt. The working or circulating capital. This is the amount that is used for the day-to-day running of the business. It is the capital available to a business for general purposes after current liabilities have been met. The working or circulating capital includes capital used for paying wages, salaries, and payments for raw materials. This could be calculated as current assets minus current liabilities. The importance of the working capital includes: working capital helps to determine whether the business is solvent or not. That is, whether the business has the ability to settle debt without selling fixed assets. Working capital serves as a check against tying down too much money for current assets. Working capital gives an indication that the business is being financed internally and not by suppliers. Working capital helps to determine the fund that will be available for the running of the business on a daily basis. Working capital can be used by a business as a basis for planning to avoid losses. Working capital provides basis for profit making by the business, since it is used to buy stock from where profit is derived. Profit. Profit is the financial benefit which accrue to a businessman. To an accountant, profit is the excess of income over expenditure. But to an economist, profit represents the reward of an entrepreneur. We have two types of profit: the gross profit and the net profit. Gross profit is the excess of turnover over the cost of goods sold. It is the difference between the selling price and the cost price of a particular product. The gross profit can be determined through the preparation of trading accounts. Gross profit is calculated as opening stock plus purchases less closing stock, and this is deducted from the sales revenue. The net profit. The net profit is the excess of gross profit over the expenses. It is arrived at after all expenses incurred in that period have been deducted from gross profit. This is ascertained in the profit and loss account. Trading profit and loss. Trading profit and loss is the account drawn up to show the gross profit and net profit of a business organization. The contents of trading profit and loss consist of opening stock, closing stock, purchases, sales, returns, returns inward, returns outward, carriage inward, carriage outward, expenses. Opening stock, this is the stock of goods at the beginning of the year. Closing stock is the stock of goods available at the end of the year. Purchases, Take 2. Purchases is the total value of goods, that is credit and cash purchases, bought for resale by an organization. Sale is the total value of goods sold by a business firm. It includes the credit and cash sales. Returns inward are those goods. Take 2. Returns inward are those goods returned by the customers. Take 2. Returns inward. Take 2. Returns inward are those goods returned by the customers, which take 2. Returns inward are those goods returned by the customers which must be deducted from the sales for the period. Returns outward are those goods returned to the suppliers which must also be deducted from the purchases for the period. Take 2. Returns outward are those goods returned to the suppliers which must be deducted from the purchases for the period. Carriage inward is the cost of transporting goods to the firm. It is normally added to purchases. Carriage outward is the cost of transporting goods to the customers. It is called carriage on sales and must be treated as expenses. Expenses are the expenditure incurred in the running of a business. It is normally deducted from the gross profit in order to show the net profit. Trading profit and loss are used to show the profit, for planning purposes, for comparison with over years, for income or corporation tax purposes. Some factors affecting profit includes 1. The selling price of goods, the number of competing firms, the cost of goods sold, that is the cost price, the relationship between demand and supply, and the knowledge of the seller concerning the market. Turnover. Turnover of a business is the total net sales during a particular period, for example, a year. Rate of turnover. Take 2. Rate of turnover is the number of times the value of average stock of a business is sold during a period. Rate of turnover is computed as cost of goods sold divided by average stock, while average stock is computed as opening stock plus closing stock divided by 2. Please take 2. Rate of turnover is the number of times the value of average stock of a business is sold during a period. This is used to investigate the market sources of the output of a firm. The rate varies from one product to another. Expensive goods have slow turnover rate, while perishable goods have rapid rate. This can be computed as cost of goods sold divided by average stock, while average stock can be computed as opening stock plus closing stock divided by 2. Factors that can affect turnover includes reduction in prices of goods, that is, goods with high prices will have low sales, while products with take 2. Factors that can affect turnover includes goodwill and reputation of the seller, reduction in prices of goods, in that goods with high prices will have low sales, while products with low prices will have high sales. Another factor that can affect turnover includes Another factor that can affect turnover is the type of goods, that is, the foodstuffs will have high turnover. Another factor that can affect turnover is the type of goods. Advertising, publicity, and sales promotion also affects turnover. Nearness of the business to consumers also affects turnover. Other important ratio. Some other important ratio includes the margin, the markup, the net profit as percentage of turnover. The margin. The margin can be defined as the relationship between the profit and selling price. This is the profit expressed as a percentage of selling price, and this could be derived through derived by dividing gross profit with selling price and multiplying by 100. The markup. The markup. Markup is a relationship that exists between the profit and the cost of goods sold. The gross profit will be expressed as a percentage of cost price using the formula gross profit divided by cost price times 100. While the net profit as a percentage of turnover is gotten by using the formula net profit divided by turnover times 100. The margin. Please delete the margin, the early margin. The margin can be defined as the relationship between the profit and selling price. This is the profit expressed as a percentage of selling price. This could be derived using the formula gross profit divided by selling price times 100.